Welcome back to our weekly update. I'm Charlotte McLeod with investingnews.com, and we're going to run through a few of the week's biggest stories in the mining industry. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and of course, leave us a comment below. Let's get into it.
The gold price had ups and downs this week, but overall moved higher, spending a decent amount of time above the $4,800 per ounce level and even approaching $4,900. Silver also fared well, breaking through $82 per ounce. Prices for both precious metals have taken hits since the Iran war began, and this week's upward momentum comes on the back of hopes that a resolution may be in sight. That same line of thinking pushed the S&P 500 to a new record high during the period. The situation continues to develop quickly, but at the time of this recording, a ceasefire was still in place between the US and Iran, with the potential to extend it beyond the initial 10 days. Israel and Lebanon have also agreed to a 10-day ceasefire. Uncertainty still surrounds the Strait of Hormuz. While Iran now says it's fully open to commercial vessels, President Donald Trump said the American blockade will remain in place until the US reaches a deal with Iran. As a reminder, about 20% of the world's oil and LNG typically passes through the strait, and its closure has led to major disruptions in those markets and elsewhere. I heard this week from Bob Moriarty of 321 Gold, who said he thinks it's still very early in the cycle for gold. In his view, the catalyst for its next move up will be a broader realization of the inflationary pressures the war is creating. Here's how he explained it.
The price of a gallon of gasoline. Okay. I went through the Arab oil embargo in 1973, and 6.5 million barrels of oil were taken off the market. Now, they weren't taken off the market in terms of blowing up a refinery. They were taken off because the Arabs just shut the taps. So when everybody was happy, all they had to do was turn the tap back on. But the price of a barrel of oil went from $3 a barrel to $20 a barrel virtually overnight. Now, the amazing thing to me, and this is so much worse in every measure than 1973 or 1979, I am absolutely staggered to drive by a gas station and not see a line 2 miles long. We pay $13 US a gallon for diesel in Europe. I live in France. And the strange thing is people still driving their cars around. They're not filling their car up. They're not standing in line. One day soon, they're going to realize, hey, wait a minute, this is very serious. We need to do something. Now,
Bob emphasized that we're living through a dangerous time and encouraged investors to protect themselves with physical gold and silver and by securing supplies of fuel and food. However, to make money, he buys resource stocks, and he sees gold companies in particular as absurdly cheap right now compared to everything else. Don Durrett of goldstockdata.com, who I also spoke to this week, made a similar point during our conversation. He spent years amassing a vast portfolio of gold and silver stocks, but he said he still sees companies with 10-bagger potential right now.
There's 10-baggers all still to this day all over the place. As a matter of fact, just about every silver producer is five-plus bagger right now. Every single one of them, which is kind of insane. But you can say that. With silver at $79, and they're all 5-plus baggers. Now, this is it. Again, I'm a speculator. When I say the Lahantin is going to go to $5, that's at $7,000 gold. Now, most people are like, Don, you're absolutely nuts. We're not going to $7,000 gold. Maybe we won't, but I can speculate that we are, and that's what I do. I'm just going to, it's basically gambling. I'm going to gamble that gold goes to 7,000. So if it does, then these type of returns are kind of there. That's why I say there's like 10 baggers all over the place. That's at $7,000 gold and $200 silver. I really don't care about the current gold and silver price. I look at a company's current market cap and I compare it to their estimated future market cap.
Going back to gold and silver, it's also worth noting the impact of the latest US Producer Price Index data. Released on April 14th, that shows an increase of 0.5% from February. The lower than expected reading has helped boost expectations that the US Federal Reserve will still be able to cut interest rates in 2026.
Of course, some experts have pointed out that the March PPI numbers don't reflect the full impact of the war. The Fed's next meeting is scheduled for April 28th to 29th, and at the moment, CME Group's FedWatch tool shows that most market participants expect officials to hold rates steady. The Silver Institute's latest World Silver Survey, released this week, shows the white metal is set to record its 6th consecutive deficit in 2026. The shortfall is estimated at 46.3 million ounces, which is higher than 2025's deficit of 40.3 million ounces. It's expected to come even with rising supply and lower demand. Overall, the Institute describes its outlook on silver as constructive, but does identify several threats to the story, including industrial demand damage due to the Iran war and the possibility of central banks selling gold, which could weigh on silver as well. Coming up next week, I'll have a variety of interesting guests, including Andy Hosey of Finding Value Finance and John Fennick of Fennick Consulting. Drop your questions for them in the comments, and as always, let me know who else you'd like to see on the channel.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.